4 times a year, the Reserve Bank issues its statement of monetary policy, where it gives its forecast for the economic conditions, both domestic and international, along with the outlook for inflation and economic growth. Recently, it's changed its forecast compared to a few months ago, so in today's Property Insider video, Dr. Andrew Wilson and I discuss their latest forecasts, plus the latest house finance approvals, dwelling approvals, rentals, and auction clearance rates. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel, join over 10,000 other regular viewers each week, and click the little bell icon so we can keep you up to date with what's happening in our property markets. In its quarterly statement on monetary policy, the Reserve Bank recently outlined the challenges it expects to face to counter decade-high levels of inflation. The bank's lowered its growth forecast and substantially lifted its inflation forecast since its May statement on monetary policy. It's now forecast that our CPI could reach 7.75% before the end of the year and then drop a little to around 4% by the end of next year, the end of 2023. The Reserve Bank also thinks the unemployment rate is going to fall even further, and this is going to fuel more wages growth, and it also tips that house prices are going to decline further. When it talked about the economy, it believes the Australian economy is going to grow by 3.25% this year and then slow down, driven by an easing in household consumption growth. Well, that's what it's hoping is going to happen, but we know the Reserve Bank hasn't had the best reputation for forecasting over the last few years. So I look forward to my weekly Property Insider chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, where we discuss the Reserve Bank's forecasts, plus lots more property news. Hi, Andrew.
Yes, good day, Michael. And we always get that sense that the Reserve Bank's statements and commentary is a little backward looking. We are really constrained in this country from the data and its timeliness that, our inflation and wages data and is very much backward looking. Our employment numbers come out monthly. But just as an example of that, Michael, next week we have the very, very important wages data to be released for the June quarter. And we're well into August. And I don't know what value this is to anybody.
Well, we know, Andrew, that the Reserve Bank raised its cash rate 0.5% again last week. It's in catch-up mode, though, isn't it? It's trying to tame inflation, but many are suggesting it's left the interest rates low for a little bit too long. But it does expect the economy eventually to slow next year, and it is hoping to pull off that difficult to achieve soft landing.
Well, I don't agree with that, Michael. I think those that are saying the interest rate raising by the Reserve Bank was too late. I think Australia is very well positioned compared to other similar economies in terms of managing inflation. Our inflation rate is significantly lower than most other similar economies, and our interest rates are lower, which I guess reflects the fact that those are saying they should be higher. But there's no sign really anywhere that higher interest rates are doing what they're supposed to do, and that's pulling back inflation. So all the talking heads will probably, as usual, get it wrong again. I think the US is very instructive to what's happening. The US raised interest rates by 0.75% again, which is an astonishing increase, and the levels of increase that are coming through are just remarkable. And there was some expectation that the data for July would start to show the impact in the US of higher interest rates, of, sharply higher interest rates, of skyrocketing interest rates. But there was an across-the-board forecast that jobs growth would be much lower over July compared to previous months. But guess what? It was higher. It was another very big month for job creation in the US. And its unemployment rate is now at 3.5%. So we've got a booming economy in the US, even though it is in recession. It's had its back-to-back quarters of negative growth. This is the point, that we're not seeing the slowdown from higher interest rates that was supposed to occur. Now, does that mean we've just got to go higher and higher and higher until we do crack the economy? Or does it mean we've got to figure out another way to live with inflation and not just trying to bury it with high interest rates? I think Australia's doing extraordinarily well in terms of its economic performance, its performance with inflation, where its interest rates are. And I think that we might be fortunate enough to be favoured by the rest of the world easing, if it does ease in terms of economic growth, before we do, which will enable us to keep our interest rates lower and not have to keep ramping them up, because we'll be dragged down to some degree by international events. As I say, I think we're sort of well positioned, and certainly we're better positioned than most other advanced economies. And the latest inflation data showed that it's still a process of goods that are driving up prices, which is all about the shortage of supply. The services are still not adding to inflation as they are in other jurisdictions, such as the US, which reflects, of course, that very strong wage rebound that's happening with higher prices in the US.
Well, I know we're going to keep talking about inflation and interest rates for a couple of months yet, but if we look at other news that happened over the last week, home loans fell sharply over June, Andrew.
Yeah, look, no surprise, Michael. I think that what's happening with home lending is it's just really readjusting again to the decline that was what started May last year, when the cycle reached its peaks and it started to decline. And then we had the COVID interruptions, and that meant that there was a lot of pent-up demand that was generated. So that easing in home lending, which was coming about through high house prices, it was just an affordability story, that high house prices were restricting buyer capacity. And that meant that home lending became more problematic. And this is the normal adjustment process that we see during a boom time period. And it reflects the tight boundaries we have around our lending environment, which is a great positive to Australia's housing market. And I think now we're just getting back to that sort of normalisation of where we should be. I mean, home lending is still quite strong in absolute levels. We're not that far back from our peak levels last May. Now, lending was down 5.3% over the month seasonally adjusted, Michael, which is actually the strongest decline since May 2020, when we went into sharp lockdown. So, but the overall trend is I think, quite predictable. I think we'll continue to see lending decline, but this is something that I think is just part of that orderly adjustment process from the boom of last year.
Well, homeowner lending has dropped, and so is investor lending. But interestingly, it's still up 1.54 billion, or 17% compared to a year ago. So investors are back in the market compared to when they sat back last year.
And there's another factor too, Michael, that we must consider with the home loan data, and that's the seasonality measures from the ABS, which have certainly been a bit of a dog's breakfast. And that's because of COVID's interrupted the seasonality econometrics. And they admit that they probably underestimated what happened in April and then overestimated what happened in May. So that's bouncing about a little bit. And that's just a measurement process, really. It's interesting with investors, of course, Michael. We know that investors are coming from a very low base. Because of the credit squeeze that was imposed on them for a number of years, they've now started to bounce back, certainly attracted by higher prices and higher rents. And they're the big performers when we look at the year-to-date and year-on-year comparisons with owner-occupiers and first home buyers. I'll tell you what's really interesting with investor numbers, though, Michael, when we look at the real numbers, not the seasonally adjusted numbers. For the first time, and I haven't checked how long it's been, but it's been a while, Victoria actually led New South Wales in the number of in investor activity, the value of investor lending over June. It's been a long, long time since we've seen Victoria at the head of the pack in terms of investor lending. And Queensland also, Michael, had another very big month for investor lending. And New South Wales was down quite sharply.
I think it fits in with what we're seeing with auction clearance rates and even the slight fall in property values, Andrew.
Yes, absolutely, Michael. There's no doubt that when we look at the auction results for the weekend, we'll see again that the Melbourne market is standing tall. Another data set that we had released during the week were building approvals, and building approvals overall were reasonably flat over the month. There's certainly no sign of a revival in building. Overall trends are continuing to fall. We are an undersupplied country in terms of housing, and there's no relief in sight for that. But when we look at some of the granular data, we can see it was another reasonably solid month for June for apartment approvals in Melbourne. And Melbourne apartment approvals, Michael, have been very strong this year. And it's not just a blip from a big development, because those numbers can be lumpy, big development one month and a little one and not many the next month. So you've got to look at the trends. But the trends are quite strong going through for Melbourne apartment development. And at the other end, Sydney and Brisbane are falling quite sharply. Apartment development in Sydney is well down, and Brisbane's well down too. But Melbourne's just another Melbourne factor is surging ahead with apartment developments.
Well, they're approvals, and let's see if they can actually get them out of the ground, if they can get pre-approvals for purchases, if they can get finance, and if they can make it financially viable. because we know that there aren't enough apartments, and that's one of the reasons we're currently having a rental crisis. Last week we had an in-depth discussion about the rental markets, but it's probably worthwhile just a quick overview on your latest My Housing Market rental data, Andrew.
Yes, Michael, it sort of broke the trend of recent months or the last year, where we actually saw a flat outcome generally for house rents over July. But I think we've got some affordability issues sort of happening there. It's just sort of, we've seen rents skyrocketing up by nearly 30% in Sydney over the year, and certainly up strongly everywhere else. So it gets to a point where tenants just can't keep paying more and more and more. So I think we've sort of reached that in the short term anyway, that affordability ceiling for house rents, because they've just been now out of the reach, I guess, or certainly out of the reach of the sort of increases we've seen. I think this will be a short-term blip, but nonetheless, apartment rental rose. So I think that's again showing the affordability factor. Got upward pressure, really underlying upward pressure everywhere, but affordability is pushing people into units, and as typically the more affordable option. And we're seeing unit rents continue to rise and a flattening of house rents. But just a news flash on that one, Michael, the last week's data, the first week in August, has actually seen an increase in house rental listings in Melbourne and Sydney, and some stabilisation of rents going forward. So we'll keep tuned to that. Maybe some winter activity happening there, which is helping the market to ease.
It is a very tight position. We've been managing properties on behalf of our landlords in Sydney since 2008. And last week, for the first time ever, we've not had one property for lease in our property management department. In the last couple of months, there's only been one or two for lease. So it's interesting what's happening. Now, we also regularly talk about the auction market because it gives us an indication of how things are happening on the ground rather than waiting for the final figures to come through. Interestingly, the weekend auction markets commenced August with a generally positive result, despite the fright of another interest rate rise last week.
Yeah, it was an interesting weekend, Michael. Firstly, clearance rates are still reasonably solid across the board. We had a blip last weekend with Sydney, which rose above 60%, but it was back down to where it's been in the high 50s around about the last month or so. Melbourne, again, was very encouraging. It had an increase in clearance rates at the weekend, up to 62%. And it's really been gravitating around that 60% mark, really, for most of the last month as well, and showing no sign of going backwards despite those higher interest rates and all the negativity that's been drummed up in the media about the prospects for housing markets. But I do think one of the interesting factors, Michael, was the number of auctions was very, very low on the weekend. Across the board, we had a big falling away of auction numbers. In fact, Sydney's auction numbers were the lowest since the Queen's birthday weekend, holiday weekend back in June. You've got to understand, even though clearance rates are telling us what buyers are thinking now, auction numbers are telling us what sellers were thinking 6 weeks ago. And I think 6 weeks ago, when these decisions were being made, whether we sell or not, was when we were really in the heat of that higher interest rate environment and all the negativity and the doom and the gloom. So I think there's a little bit of that phobia, fear of being involved energy showing up in the auction listing numbers at the weekend, but buyers are certainly still happy to secure property. And we may see that for the next few weekends. And what we might do, which I'll just reveal the first statistic of that, is start looking at how overall new listings are travelling at the moment. Because overall new listings, which we track on a daily basis, tell us how sellers are thinking about the market here and now. And I've tracked a 17% increase in the number of new listings coming into the national market over the past week. So this is what we typically see early August, is new listings starting to come back into the market. Now, this is only happened over the last week, so it's an early trend, but 17% is quite a big rise, but nonetheless not a surprising rise given the time of the... So listing numbers in the auction market tell us what's happened a month or more ago, but those new listing numbers are telling us what's happening today. So another sign, Michael, that the market's maybe just holding the line a little bit better than a lot predicted with higher interest rates. And doesn't that sort of work its way into the same narrative in regard to what's happening in the economy with higher interest rates?
Yes, it does. I guess there were a lot of discretionary sellers who just sat on the sidelines waiting to see how things would pan out. But then eventually they realised, well, I've just got to get on with my life. And now they're putting their properties on the market. So it'll be interesting to see what the typically stronger spring auction season is going to be like.
And that'll show up in the auction numbers in about a month or so time, Michael.
Well, that's all very encouraging. Look forward to catching up with you again next week as we see what transpires in our property markets, Andrew.
Yeah, thanks, Michael.